Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible. Guys, welcome back to another episode of On the Margin. Today we're joined by repeat guest Bob Elliott. Bob, welcome back to the show, my friend.
Hey, how's it going?
It's going well. Not as well as you. I know you just had a new young daughter, so congratulations on that, Bob. All very, very excited for you. That's great.
Yes, thank you so much. It delayed our chance to talk to each other, but I'm glad we got to get together now, and I think possibly on like the most important day of policy, well, at least in the last 3 months, if not in the last while, since the failed pivot last winter.
Yeah, well, we can maybe loosely dub this the Super Bowl of policy, at least for 2024 so far. Why don't we start, Bob, with the FOMC, just since we know, especially listeners of On the Margin and FinTwit and Macro generally loves to hang on every word of Chair Powell. So maybe just starting at a really high level, we were talking a little bit beforehand about so a little bit of confusion and trying to get a sense of where the Fed is really at. And so I'd love to get your opinion on just where their headspace is at the current moment. But maybe could you give, for listeners who might have missed it, just a summary of this FOMC, what were sort of the salient points, and then we can get into the context around it.
Yeah, well, I think there's basically two important points I think that I took away from the FOMC meeting. From a policy standpoint, the first was at least an acknowledgement in the statement that the progress towards getting inflation back to their mandate has stalled, which I think is a very conservative way of recognizing that the data over the course of the last couple of months has certainly, at a minimum, been inconsistent with getting more confidence and probably indicating that inflation may be moving in the wrong direction relative to their mandate. And then I think the second matter, of course, they kept interest rates constant because that's what everyone expected, and they largely just adhered to the basic expectations that coming into the meeting. But the main policy change was tapering the QT, the pace of QT, which is a little confusing mismatch of directional words, which basically means right now they're letting the balance sheet roll off for treasury bonds at about $60 billion a month in terms of what's maturing, and they're going to slow that and only allow about $25 billion to roll off a month. And so there was some expectation that they were going to slow the pace of quantitative tightening. But on the margin, I'd say this was, probably the median expectation was about 30. They were going to go from 60 to 30, and here they announced going from 60 to 25. So, a little more dovish than, very marginally more dovish than what people expected from a policy standpoint. So that's the basic announcements. I'd say in terms of a take, it's kind of an interesting combination of things. Most people expected some sort of shift in quantitative tightening to slow that pace coming into this meeting, either this meeting or the next one. So that wasn't much of a surprise, but it is pretty weird for the Fed to basically say we're going to engage in an easing action by slowing the pace of QT. At the same time, they're basically ramping up their rhetoric to highlight the fact that they're getting further away from their inflation mandate. And so those two things, easing while becoming farther away from your inflation goals, is at best a bit inconsistent and at worst probably imprudent in terms of a policy mix that we're seeing.
So, Bob, what do you think is driving that policy mix? I mean, we're going to talk about the QRA as well, and there's been an enormous amount of focus on the Treasury and fiscal writ large. But what do you think is driving this particularly sort of confusing move?
Well, I think there are folks in the Fed who are at least making the case related to the balance sheet that engaging in quantitative easing, which is the outright purchase of longer dated treasury bonds, is functionally an easing in the markets, and you can imagine why, which is basically when you buy treasury bonds, it both depresses the yield on those bonds, which is stimulative, and also provides more money that gets injected into the financial economy. And so there's folks in the Fed who argue that that is an easing, buying bonds is an easing, but at the same time argue that that letting the balance sheet roll down is not a tightening. And so from that stance, the officials, and to be frank with you, that doesn't make a lot of sense to me, because to the extent that bonds are maturing, long dated bonds are maturing on their balance sheet and then are not repurchased by the Fed to keep their balance sheet constant, it means someone in the private sector has to buy those bonds, which means that they have to trade at a higher yield or a lower price in order for someone to be incentivized to go buy those bonds when they get reissued. So that doesn't make sense. But the Fed eggheads really think that that's how monetary policy works. Frankly, without a lot of empirical evidence or common sense evidence to support their case. And so, from the Fed's perspective, slowing the pace of QT is effectively, they're viewing it as not a monetary policy activity, even though I think it is. And what they're really worried about with quantitative tightening is that by rolling down the balance sheet, they're reducing the amount of liquidity in the system. And I'm sure folks who listen to this on a regular basis are often hear about various measures of liquidity in the system, particularly the RRP, which gives some indication of excess liquidity or excess reserves in the system, where there's some indication that if quantitative tightening rolls off, then that RRP will fall over time, which would then create less excess liquidity in the system, initially in the RRP, and then eventually, as quantitative tightening as it keeps going, would eventually start to create a fall in bank reserves. And Chairman Powell, acknowledged very specifically in the meeting, in the presser, how he's very concerned about what happened in the 2018 period, where there was a liquidity problem and wasn't enough reserves in the system for the banks, which created a spike in repo and other short rate markets. So they're very, very concerned about that. So from their perspective, you're getting in their head, they see slowing QT as having no monetary impact, no monetary policy impact, and is helping deal with that liquidity problem that could exist were it to continue at its current pace.
And Bob, what do you think about that? Do you think that we should be worried about any sort of liquidity problem? Maybe we can start to transition here into the QRA. But I believe there's some $500 billion in the reverse repo facility today. I will say, Janet Yellen has actually proven pretty adept, I would say, in terms of some of her issuing tactics earlier in sort of the spread between longer dated securities and coupons. And maybe we can get into some of the specifics about what the QRA ended up yielding. But should we be ultimately worried about some sort of liquidity problem on the horizon? And I don't know, if you were in Chair Powell's seat, how would you balance that against this sort of concerning trend for the last 3 months in terms of hotter than expected inflation prints?
Yeah, I think from a liquidity perspective, if you're a bank, there's never been a time where there has been more liquidity in the system. And so, with any perspective, you look at it and you say, wow, there's a ton of liquidity out there. Not to mention the fact that the Fed, through a variety of different efforts to destigmatize short-term borrowing, somewhat through the BTFP, and then also through their efforts to sort of normalize discount window borrowing, means that if you're really in a struggle for incremental liquidity, there's plenty of in general, there's plenty of liquidity available. And if you're squeezed, you can get it. It might be at a painful rate. But basically any of that liquidity is at a painful rate. And when you go down a level below, of course, bank reserves are not equally distributed amongst banks. Some have more, some have less. But, the big picture story is, like, banks are not going to be failing anytime soon because of a liquidity problem. And there's tons of liquidity in the system. So, I think that's kind of different. Since 2018, we've expanded the balance sheet on the order of several $1 trillion. So, what was the concern back in 2018 doesn't really seem all that pertinent to the matters that are going on today. But, they're being very cautious, basically. They'd much rather have more than enough liquidity and not have to worry about that situation than frankly, run tighter monetary policy that might be more in line with the macroeconomic fundamentals. And so, I think that's the basic story. it's probably too easy relative to the concerns that they have. On the Treasury side, the frank reality is, for all the talk about the QRA, like basically nothing changed.
Right.
If you look at the coupon issuance sheet, there's tweaks at $1 billion of this issuance or that issuance that are mostly related to the specific calendar dates and stuff like that. But like, it's basically like there's a lot of issuance in the last quarter. There's going to be a lot of issuance in the second quarter. There's going to be a lot of issuance in the third quarter. Like, not much is really changing, which in and of itself is notable, because I think a lot of people, a subset of people, thought that Janet Yellen might do whatever it takes to gas asset price returns in coming into the election. And I think this QRA announcement basically confirms that the technocrats have won. And what the technocrats are doing is saying, we're just going to issue consistent with our normal debt profile.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you, and I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes. So the QRA, it's funny. I mean, that has come into, it's been like an enormous area of focus recently, but I know Andy Conson has done a great job of mentioning this, but for many years, I mean, no one focused on that or cared about it very much at all, right? It's just been the topic du jour. And, Janet Yellen, to her credit, I mean, I think she's done some pretty nimble maneuvering. She messed with that, sort of 80-20, maximum 20% of coupons ratio. And honestly, I mean, from my perspective, I think she's done a pretty good job for the most part. But, what do you think? I mean, here, I'll pull up the most recent QRA numbers from today as well. But I'm curious if you had any takes, or if anything stood out, or you basically just think, yeah, this is sort of par for the course.
Yeah, I think the main question on the QRA is basically what the debt profile of the U.S. is going to be, and the reality is, and to the extent that it's longer duration issuance, that puts more pressure on long-term interest rates and subsequently more pressure on overall financial assets. And to the extent that it's shorter dated in nature, it puts less pressure on financial assets. I think the challenge is that the deficit is so big that it is going to require a lot of issuance of one form or another to basically fund this enormous deficit that we have going on right now. And there are steps that can be taken on the margin to tweak, and Janet Yellen did take steps on the margin to tweak it. But there's not that much they can do when you just have so much financing you've got to get done.
Yeah, and I mean, do you think that? I mean, I know I've seen you tweeting about this, and I feel like there's been rightly a lot of focus on the steadily creeping up more longer date, like the 10-year, and so. It feels like maybe zooming out of today and some of the policy announcements that we've gotten, when people are looking back and trying to do a retrospective of the last 18 months and saying, hey, we did a very steep series of rate hikes and basically nothing broke and the economy has been relatively strong. And, most people are starting to coalesce around this answer that, yes, on shorter dated yields, right? The 2-year and below and 2-year below, I mean, it's been a very steep increase, but the longer dated yields haven't moved very much at all. And so how much emphasis do you put on longer, like the 10-year and the 30-year here moving up? And is that an issue for markets?
Yeah, well, I think the 10-year and the long end, out to the 30-year is the rate that is the most impactful rate on the economy. Both because it typically sets the borrowing rate for most borrowers in the economy, whether you're borrowing, for a house or whether you're a corporate borrower at this point, is much more tilted towards the long end than the short end. Although there are some floating rate borrowers that are out there, particularly sort of private equity, private credit oriented businesses. But mostly the long end is business borrowing as well. So that sets the rate for credit creation. And it's gone up enough basically to slow credit creation substantially. There's basically no very, very little net credit creation in the economy, given the current level of interest rates. The other thing it does, which is probably more impactful these days, is that it sets the discount rate for all financial assets. And therefore, if that interest rate rises, then it affects basically all financial assets, stocks, gold, commodities, everything gets affected by it, credit instruments, et cetera. And so I think that's where its real effect is it going to put pressure on overall assets to fall, or is it not putting pressure on overall assets to fall? And so, we saw last summer, as the 10-year rose through to 5, we saw stocks fall, 10 or 15%. And that gives you a sense as to sort of what the sensitivity is of the economy to those higher interest rates. So it's a critical component of whether or not we're going to get an asset price decline here.
And so, right now, if you look here, let me see if I can pull up this chart of the last of the 10-year over the course of the last year. Not that I'm some kind of TA guy drawing lines on charts, but I mean, it is interesting to watch. Yield spiked at over 5% back in November of this last year, and it looked like it sort of bottomed there, and it's been steadily climbing, and now we're at back above 4.6. And admittedly, the 10-year and the 2-year both sold off today after the FOMC, which again was probably interpreted as relatively dovish, but it does look like yields are starting to climb back up. And I guess my question to you would be, do you see a sustained rally here, or are yields going to turn back around, do you think?
Yeah, well, I think the trouble, and this sort of connects with the issuance point that we were talking about before, is that every day what's happening is the government is coming to the market, issuing bonds and issuing bonds and issuing bonds, and every day they've got to get somebody to buy those bonds. And how do you get somebody to buy those bonds? Well, you have to get them to buy it at a higher yield or a lower price. And so that's essentially what we're seeing here. Is it's like water drip torture on the bond market, that day-to-day flood, that day-to-day issuance of bonds. And I think one of the challenges is because it's such a big issue, the Treasury is such a big issuer, that no one can front run it. Like, I could tell you that the Treasury is going to issue, $3 trillion of gross coupons over the course of the end of, between now and the end of the year. And like, who's got the balance sheet to pre-position for that? Like, basically no one. And so that's why it ends up being like, it feels a little, it feels a little disappointing when these things happen, because you're like, nothing really happened in the market that day. And then every day you come in, you see these pressures on bond yields that we've seen, in the, for the last, since the start of the year.
Yeah. And so where do you think this ends? Because, if you look at estimates from, even the CBO, the Congressional Budget Office, all you see is continue at I think it's something like $2 trillion a year that has to get funded from somewhere. It's going to be the Treasury issuing more and more yield. So do you, or more and more bonds. So do you see sort of consistent pressure on yields to go higher from here? And if so, how does that sort of doom loop stop?
Well, I think we're in a challenging point, because the yield rises that we've seen so far are enough to start to cap asset price appreciation, which we've seen. Stocks have basically peaked and traded sideways to down a little bit, but the yields are not high enough to create a slowdown in the economy, which would then start to create a demand or a bid for those bonds, say relative to stocks. And so in this transition period, it's almost like we're in a gap. We're moving through an air pocket where stocks are too high and bond yields aren't quite high enough to create the easing to then turn them around. And so you need to get bond yields to move up enough to create not enough pain on stocks to create the easing to then create the bid for bonds. That's that's how these markets work. Is they're reflexive in that nature, right? And so we probably need bond yields in the 5.5 range to start to get enough of that slowdown in the economy to start to make sense to then go long those bonds. So we're in an empty spot right now, it seems.
And so while we're in this air pocket or this empty spot, where do you see the underlying trend of inflation? So obviously over the course of the last 12 months or so, we've seen this trend of disinflation, but in the last 3 months, that started to reverse. And you heard Chair Powell, today talk about how they're paying more attention to the data and it's moving in a slightly undesirable direction. So, I guess to follow on that, well, what do you think about the sort of trend of inflation right now? And then I've got a follow-on question about the 2%.
Yeah, I mean, I think we really when the pivot happened last winter, it was like we had an optimal combination of disinflationary pressures that was driving the measured inflation number to be at 2%. And so you had used autos were falling. You had gas prices went from $4 a gallon to $3 a gallon. You had imported goods prices that were falling pretty rapidly. And I think at the time, what I said is the problem is we're getting 2% at a point where we have maximum disinflationary impulse from those areas benefiting from the supply chain resolutions. The problem is once those areas that were benefiting no longer were disinflating as fast, right? They prices are still falling in some of those cases, but they're just disinflating not nearly as fast. And gas prices turned. We went from 4 to 3, and now we're back up to 4, or on a path to 4, given traded gas prices. That basically resets the level of where we are in inflation and highlights the fact that the sort of underlying inflationary pressures in the economy are closer to 3 to 4 than they are closer to 2, right? Which means that that's going to be very challenging unless we create some demand destruction or we get productivity gains, unusual productivity gains. One of those two things has to happen, or we will have inflation settle at this sort of 3 to 4% level, which is definitely too high for the Fed's mandate.
So, all right. So we had Vincent Delaware down here the other day, and actually he made this call about a year ago. But he was describing this idea of it's not R star, I believe it's I star. It's the natural rate of inflation, and his contention even back then was that it was around 3 or 4%, something like that. And I guess my question to you is if let's just say that there is a natural rate of inflation, some of those disinflationary impulses that you were saying, just bringing more supply back online, have stopped, and inflation really should be around 3 or 4%. Does the Fed have the tool belt to actually bring inflation down to 2% if the natural range is higher than that? And then B, would they try to do that? Because I would imagine that's going to inflict an enormous amount of pain on the economy.
Yeah, I mean, well, the first thing in terms of answering the question of do they have the tool? Absolutely. Like inflation would not be 3 to 4% if interest rates were 10% right now. Like, so it's just a question of do they want to do it, right? Do they want to inflict the pain necessary to achieve those inflationary outcomes? And I think that the challenge is if we're talking about the difference between 2 and 2.4%. I think, lots of folks, I mean, who knows? Measured inflation, it's just a measurement. It's just some government data. It's not like, the truth in, it's just some data. I think the Fed could make the case. Look, if inflation is 2.4%, it's pretty close. Don't worry too much about it. We're in the ballpark. I think the challenge is if it's really 3 to 4%, then then it is too high. That plain and simple. It's too high. It's not at their mandate. They have a problem. And you can almost see it with what Chairman Powell was saying earlier today, and what's in the statement, in the Fed statement, which is like, it's too high. Like unambiguously, what's going on right now is too high, right? We're not going to let it go here. If it's 2, 2.4, 2.3, they'll probably let that go. And so that's the basic trade-off. Then the question is, what do they have to do to get it there? And, right now they're not doing much. There's a lot of hope and not a lot of action to bring it down more sustainably to their 2% target.
So, what do you think in terms of this is the perennial question that everyone loves to ask, right? In terms of rate cuts versus rate hikes. Going into this year, there was an enormous amount of optimism that was being priced in by the market, something like 6 or 7 rate cuts. And now that's actually swung, and the Fed, with their dot plots was giving us, I believe, 3 cuts. And now that's actually swung the other way, where the Fed has stayed relatively constant, but the market was pricing in actually fewer cuts than that. And you've got guys like Larry McDonald, who are actually saying that the Fed should be hiking rates at the current moment. So maybe I'll ask you this as a 2-part question. What do you think the Fed is going to do in terms of rate cuts versus rate hikes? And what do you think they should do, if those are 2 different answers?
I think the answer in terms of what they probably will do is not much. And part of that is if you've been around a few central bank cycles and looked at central banks across countries across time, I think there's always a disconnect between what they say that they're going to do and what they actually do. Like, inertia is one of the most powerful forces in central banking, and there's always an inclination to do nothing and gather more data, because gathering more data always sounds like a smart idea, right? Everyone wants to gather more data. And basically, they only act urgently in an environment where it's so clear that economic conditions are meaningfully deteriorating. Then they act very urgently. But that's not going on right now. And so if there's no urgency on economic conditions deteriorating, then their natural inclination is to do absolutely nothing. And that's probably what they'll do. And so if you connect it to the market pricing, like what's going on right now is, the markets are pricing in roughly 1 cut through the end of the year. Like, will they do 1 cut? Will they do 0? Like, look, I got bigger fish to fry than nitpicking over 25 basis points on SOFR. I think the much more interesting question is, let's say they do nothing. Is simply holding interest rates where they are enough in order for them to accomplish their goals of bringing inflation durably down to 2%? And I think the answer is probably not. That's what we're seeing right now. It's probably not enough. So they might not do anything. It's probably not enough. And so what that means is that you're more likely to get a market-based tightening, which is, if the Fed's not going to do enough, then the long end will do the job. I'm not quite old enough to know about the bond vigilantes, but I've heard of them, and they might reappear.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, we've got, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there. Well, this is, and this is, again, I mean, I got to shout out our mutual friend, Andy here. But, this is his 5-act script to kill inflation that he's been talking about forever. And, I think it's Act 3, which is the compression of term premia, which means the long end of the curve moving up. And it seems like that's finally maybe starting to happen. So I guess we'll see if those bond vigilantes that everyone seems to remember so fondly from 30 or 40 years ago, if they're going to end up riding back on their horses and slap the markets around a little bit. But yeah, I guess we'll have to just wait and see if that's ultimately gonna happen or not.
Yeah, well, I think the part of the thing is the supply story is one in which you could have passive vigilantism, in the sense of, like, because you have to issue all this debt, and you have to incrementally get somebody to buy it. You don't necessarily need someone to be actively, in some ways, expressing a negative view on bonds in order to get that yield rise, right? Just simply the process, you issue the bonds and somebody has to buy them. And there's just where are the balance sheets? Like, there aren't that many buyers out in the market that aren't, filled to the gills with bonds these days. You basically long only bond managers, they've bought all the bonds that they can. Banks, plenty of bonds. Global central banks, not interested. Pension funds have a lot of bonds. Genuinely, who is going to buy the bonds? at the current price? Like that's the question you have to ask yourself. And I think the answer is like, I'm having a hard time finding the person buying the bonds at the current price unless we have a massive, exogenous deterioration in economic conditions or the yield rises. Like those are the two things that have to happen in order for it to get funded.
Let me ask you this, Bob, just in terms of, your statement there that foreign central banks aren't particularly interested. Are you of the opinion, not to make this a geopolitical podcast at all, but there was obviously I can't remember, a year or two ago when the U.S. seized some of the Russian central bank assets, and I saw there was actually a bill to reappropriate some $8 billion worth of those frozen assets towards Ukraine, which, regardless of what your opinion is on the war in Ukraine or Putin or whatever, it seems like a pretty drastic step in terms of actually moving from a freeze to outright reappropriating those assets. And I would be curious, just in terms of this whole question about who is going to buy the bonds. Do you think that was maybe a deterrent on marginal, central bank buyers to actually load up on U.S. debt, or what's your whole opinion on that subject?
Yeah, I think in a lot of ways, like we had a long period where central banks and particularly Asian investors were running very large balance of payment surpluses and intervening significantly in their currencies, which created a substantial incremental bid for bonds on an ongoing basis. And I think the thing is that really hasn't been in play for a while, right? I mean, really 5 years or something like that. 10 years, they really have not been buying bonds incrementally. So I think the real question is, what are they doing with the stock of assets that they have available to them today? And are they thinking about incrementally rebalancing away from dollar bonds in terms of their asset allocation? And what I'd say about that is, in one level, it's pretty tough to, because there's a reason why they bought dollar bonds. It's the biggest, most liquid asset market in the world. And so, there's not a lot of other options that are out there to just, go allocate trillions of dollars of liquidity to. That said, on the margin, the lessons, particularly for central banks of countries that have been, adverse to the United States, let's say, they're recognizing that, unless the gold is in their vault, they don't own the asset. Their crypto friends should have told them, given them a few hints about holding the asset in their hands, right? So they're going out and buying gold and such and things like that. But the reality is, the gold market is teeny tiny relative to the bond market. And so even modest incremental demand, can create large price spikes in those asset markets in a way that is, challenging, to say the least, to allocate capital. So they're kind of stuck, is the reality. They're probably not going to sell that much. They're certainly not going to be buyers. They're probably going to put a squeeze on sort of incremental markets that they can allocate to. But that's basically the story that's going to happen.
And on the gold market here, because this is one of those things that every once in a while it makes headlines, and you see these central banks that the Russian central bank's been buying gold for a while. Gold recently made new all-time highs. So whenever gold peaks its head up, people start to say, "Oh, it's happening. It's just finally happening." But I would be curious to get your perspective on just gold in general, Bob, especially here. I mean, do you think that gold is moving, as historically it's moved inversely correlated to real rates? Do you think that's what's been driving gold here? Do you think that people are starting to get worried about the supply story around bonds? Do you think this is actually, I wouldn't call gold an illiquid asset class, but it's definitely not as liquid and large as the U.S. Treasury market, for instance. Do you think this is just some incremental buying that's driving the price up? What do you think is moving gold here? And are you a fan of the asset? I actually am not 100% sure your opinion on gold. Do you like it as an asset?
Well, then you haven't been listening to enough Bob Elliott commentary. No, I love gold as an asset. And as a portfolio asset, and the reason why that is it's a diversifying exposure. And so I think a lot of folks don't realize like gold outperforms bonds about half the time in equity drawdowns. So it's a better diversifier than bonds, in 50% of weak equity markets. And, everyone holds bonds and essentially no one holds gold. So, which just doesn't make any sense from an empirical perspective. And the last 5 years have been a pretty good test in terms of showing how gold has provided a diversifying position relative to bonds in terms of an overall portfolio. So, an allocation of 10% of a strategic portfolio to gold makes a ton of sense. That doesn't necessarily mean, at times it's tactically a good buy, at times it's tactically a bad buy. What I'm talking about there is I'm just saying strategically, you hold bonds in your portfolio, hold some gold. That's plain and simple. I think in terms of gold from a more tactical perspective, I don't really think what we're seeing is much of a reflection of people's views on U.S. monetary and fiscal conditions driving the gold price up. Almost all the demand that we've seen in the gold market in the last couple of months has been concentrated in the Chinese gold markets, seeing the Shanghai premium trade relatively significantly, domestic-based gold ETFs trading at 30% premiums over the spot price, activity in the Shanghai futures market being like 4x what it was last year. So most of it is related to Chinese residents trying to figure out ways to get money out of yuan and into other assets when things like Bitcoin it's not available because it's illegal, or not as available because it's illegal, or capital controls are in place to move money offshore to find dollars. And so I think that's more of the story. It's more of a Chinese concentrated story. Western investors keep selling gold despite it going up, which is kind of a wild thing. It's like the only asset in the world that people keep selling when the price keeps going up.
That's interesting. One thing that I've encountered, less so with gold, but more so with Bitcoin, which is, depending on your view, sort of a similar, at least narrative around it, is one of the challenges that I've always bumped into around Bitcoin is doesn't have a yield. And I know that this is a thing for gold proponents as well that they've run into. This is why Paul Tudor Jones calls it the barbarous relic, right? It's because it doesn't have a cash flow and people can't back it into a DCF, or they can't model out what the returns are going to be. And that's not an attitude that I have, personally. I know that's not your perspective as well, but maybe I've always sort of ascribed the yield story as being, pretty challenging for gold, because no matter how you can backdate it, you can show that it's a diversifier in portfolios, you can show its relative performance, but many people just revert to this line of, well, there isn't any cash flow, so there's no intrinsic value. That's a powerful mental model that a lot of people have.
Yeah, I think it is, and I think what it is it's a model built on experience with based primarily on dollars, where fiat yielding fiat looks better than non-yielding hard money in an environment where we've had 40 years of secular disinflation. But I think if you just expand your perspective a little bit more, what you'd find is that there are many instances where fiat money, let's say fiat bonds or fiat cash, meaningfully underperforms bonds, right? Or meaningfully underperforms gold over time. And if you look at the last, let's say 150 years of fiat currencies in the developed world, like holding gold would have been a better trade than holding those currencies in something like 60 or 70% of instances. And again, like what I'm not saying, put all your money in gold because that's the best asset to hold. That's not what I'm saying. What I'm saying is, like, everyone seems convinced you want to hold bonds, but the empirical evidence narrowly last 5 years, broadly, during the floating exchange rate period since 1970, over the last 150 years of fiat money, like, how many other ways do I have to prove to you that gold is a good diversifying asset, without, people finally accepting that is the reality that's out there? Like it's almost like it feels like it's a religious belief that to be denying gold as being a good portfolio diversifier, and that it doesn't make a lot of sense.
Yeah, I'm with you. I'm with you on that, and I think there's a reason that it. There's I think there's a reason why macro guys tend to like gold, and they have a more flexible understanding of how to make investments and asset classes writ large, right? Like I think a lot of the popular discourse around investing is dominated by equities guys, right? Equities guys and gals who,
right. That's right.
they have this very dogmatic view around how to, shove something into a DCF and model out the returns. And that just feels very comfortable. But I do think there's obviously tons of value in investing in things like gold or commodities or whatever it is. And there's
right. I mean, certainly,
yeah,
certainly commodities. I mean, you and I might not see eye to eye on Bitcoin, but I will say this, that the fact that Bitcoin doesn't have a yield on it is not a particularly relevant consideration to thinking about whether it's a good storehold of wealth or transaction currency, right? That's not the matter. That's not the matter of concern related to it. It certainly has plenty of volatility. Like that's not the problem.
Yeah.
So it's and I think you're right. I think part of it is like there's a beautiful tangibleness of bonds and their yield, and of stocks and their dividends and cash flows and things like that. And there is more ambiguity in many ways, it seems, with things like gold and Bitcoin and commodities and things like that. But we've seen a long track record of those assets having positive returns, and returns that are complementary to a portfolio, to an overall investment portfolio that makes sense to include them, not at 100%, just 10% in commodities and in tradable commodities and gold into a 60-40 portfolio would meaningfully improve the long-term risk return profile without creating a return drag. And so that's a pretty good trade to make.
Hey, you're preaching on the choir here. I'm with you. It's just I'll see if I can find this quote from Jack Bogle. Jack Bogle summed this up so well. He was, he was a very good storyteller, very good investing storyteller. He made things make a lot of sense. But he described the difference in investing in equities versus commodities, and I don't particularly agree with it, to be honest. But I see why it seduces so many people. But Bob, I want to get your perspective here before I know we're to start to wind down soon. But I want to get your thoughts on oil here, and maybe if we can knit this back into your understanding of inflation. So oil, it was one of those. If you even rewind back to COVID, oil was one of those things. That was initially where some of the inflation in the early days of CPI starting to creep up. That's where it came from, and then it sort of leapt over into some of the stickier components like shelter, et cetera. And over the course of this past year, oil has started to creep back up again. There was the selling off of the SPR last year. The government said that they were going to try to refill the SPR. They quickly walked that back. But yeah,
I'm waiting for that one to happen. I don't think President Biden's going to refill the SPR, in the 3 months before the election.
Probably not. That would be pretty unwise. But oil has started to move the other direction, at least over the month of April. It's down some 15 or 20%. And I'd be curious just to get your thoughts on where you see oil going from here, if you have a view, and just generally the role in inflation.
Well, in many ways, in inflation, like oil, or inflation is oil, or oil is inflation.
Right.
It's such a critical input into so many things, and gas prices in particular being a critical input. Even with the decline in oil prices, for a variety of reasons, we are seeing some continued strength in traded gasoline prices. So you haven't seen quite as much of a weakness, and so we're likely to see retail gas prices still rising on a forward-looking basis rather than falling, despite the recent fall in input oil prices. I think in general, the oil market is one that is structurally oversupplied, in the sense of the prices that we're seeing today are a function of a significant amount of shut-ins and constrained supply by OPEC plus to prop up the current price. And so in that sense, it's sort of an unnatural price, like left to its own desires, left to a totally free market environment where the Saudis are pumping everything that they can. We'd see much lower oil prices, in part because we've had such a huge increase in supply coming out of the U.S. It doesn't get talked about much, but like the significant U.S. supply picture in oil has been like critically important in keeping a lid on prices. I think we're just kind of in this, oil in some ways, it is a geopolitical asset, which can be meaningfully influenced by geopolitical policy considerations. And so the fact that, certain producers are choosing to constrain their supply is a consideration for why we have prices at this level. And so, I mean, I think we're in the range. Odds are it probably won't go a whole lot higher. Odds are any meaningful downward pressure is going to be met with more shut-ins. And so, I'd say in some ways oil isn't that interesting a market to trade right now relative to some of the other financial markets, because you sort of have that natural, or maybe not natural, you have that policy-oriented capping and flooring in oil from those OPEC plus producers.
Yeah, and I know you mentioned the part about the election here as well. I would assume that you're in the camp that it's not like policymakers here are trying to control the price of oil for for this election, but to your point, that extends to also probably we're not going to try to refill the SPR 3 months before the election as well.
Right. I mean, I think it's the sort of thing where it's not like every policy decision is being driven by electoral considerations, but like there is policymakers are smart enough not to do stupid things.
Right.
Right. In terms of, like jacking oil prices up right ahead of an election would be a pretty stupid move for policymakers to do, or at least incumbents to do. And so we probably aren't going to see much of anything related to that. Just more of the same.
Yeah. Well, Bob, I know we've come to the end of our time here, but for folks who I'm sure, guys, if you're listening to this interview, you've probably heard Bob speak other places or on past episodes of On the Margin. Can't speak highly enough of Bob's perspective and analysis here. And Bob, if folks want to find out more about your work or anything like that, like what's the best way to do that?
Yeah, I'm pretty active on Twitter, so definitely follow me, Bobby Unlimited. I also have a YouTube channel, which is kind of some highlights of various conversations like this, which I think people find interesting. And we also do a monthly conversation, sort of a monthly outlook conversation, which folks like to take a look at as well. So definitely check that out on YouTube. And then for more sort of the financial industry commentary, I also write a little bit on LinkedIn, but that's more sort of professional oriented commentary. So if you're into that sort of stuff, go ahead and check that out as well.
So this is where you let your hair down, so to speak, on these types of things.
That's right. That's right. This is where I tell you the truth of how I'm really thinking versus I'm always saying that. Gets me into some hot water, but keeps me honest.
Well, we appreciate you for it, Bob. Well, thank you so much, Bob. Really appreciate your time. We'll have to do this again sometime soon, my friend.